My name is Lars Hansen. I want to welcome you to this event. This is hosted by the Becker Friedman Institute, Credit Suisse, and the CME Group. So I'm the research director at the Becker Friedman Institute, which is one of the reasons I'm here tonight. I'm pleased to be here, although it's been a bit of a sad few days for the Institute, for the University of Chicago as well. As most of you know, this weekend we lost our friend, colleague, and the Institute chair, Gary Becker. So Gary I got to the University of Chicago in the very early 80s, so he's been my colleague now for he's been my colleague for over 3 decades. I was very lucky that we had offices next to each other over the last several years and had just a whole variety of very important interactions. Gary's been a really remarkable scholar in a variety of dimensions. I view him as kind of certainly one of the top few economists of the 20th century. He remained incredibly productive into the 21st century. Incredibly active and the like. He really expanded the domain of economic analysis into a whole variety of social problems, all the way from economics of the family to the economics of economics of crime to human capital and the like. And not only did he kind of expand the scope of economics to the whole array of new social problems, along the way he also pushed and developed the development of new economic modes of analysis that were rich enough to address these social problems. So he is just fundamental in terms of broadening the whole scope of economics. But his contributions even went beyond this. Gary was taught a class for a long time in price theory at the University of Chicago, and it was kind of known to be an incredibly special class that had many students, and now there's many students of students and the like, and just have a huge impact that, basically students would come out of there trying to think like an economist, at least Gary Becker's version of an economist, where economics is taken very seriously and is a valuable tool for analyzing just a whole wide array of social problems. So in a very central way, he expanded the scope of economic analysis and to address very, very important problems, and in ways that prior to him were just really not conceived of as being the domain of economics. So it's certainly a huge loss for the, I kind of think of Gary as being the face of Chicago economics. So when I got there in the early 80s, Milton Friedman had been gone for, already about 5 years or so. I mean, Gary was the intellectual leader, and he's going to be a big loss. We certainly have his intellectual legacy to go forward, and we're very pleased to have that, and I'm very pleased that he's part of the University of Chicago economics tradition. So tonight we're going to be talking about issues related to macroeconomics, financial markets, and the like. Before we get going on the actual panel discussion, I want to talk a little bit about research and initiatives at the Becker Friedman Institute, and also give you a little bit of my own perspective on some of why these topics are important for economic analysis. So let me start. So the Becker Friedman Institute has a whole array of research initiatives that address a lot of important problems. I've listed 3 here that are all connected to the topics which we'll be exploring tonight. We've formed what's called a macro financial modeling group that includes researchers around the world that are interested in building new connections between macroeconomics and financial markets. If you look going into the financial crisis, a lot of the macro models had financial markets in them that were relatively passive. There was not a lot of research being done on the connections between the two and the role of financial markets in terms of affecting macroeconomic outcomes. There's been a real big shift in thinking, and this has kind of opened the door to lots of important research challenges. This group was formed with kind of top people coming out of the finance profession, out of the macroeconomics profession, with a shared common belief that we have to build better models for macroeconomic policy advice and for that showed a much richer connections between financial markets and the macroeconomy. We've been doing related research on fiscal imbalance. Most recently, the Institute hosted scholars from around the world focusing on fiscal histories coming from all the Latin American countries. As many of you know, Latin America has had some rather interesting experiences with a variety of fiscal policies, and our job is to try to assimilate and to understand better what that historical evidence tells us. Most recently, and this is what I want to talk about a little bit more tonight, because this kind of pervades lots of topics within economics, and we've been launching an initiative on the price of policy uncertainty. There's lots of speculation that policy uncertainty is a contributor to sluggish economic growth. It's harmful to economic activity, but the amount of formal quantitative research supporting that remains somewhat limited, and we kind of hope to push that frontier much further, both from a theoretical level, but also from an empirical level. Part of our mission has been to nurture undergraduates and MBAs and PhD students in terms of activities at the Institute. We run something called the Friedman Forums for undergraduates. We run Becker Brown bags for MBA students. We also run research experience for undergraduates. One of the undergraduate events, which I want to allude to now, and I'll talk a little bit more subsequently, is in December of 2012, just before that there was kind of a refocusing of the so-called forward guidance policy of the Federal Reserve Bank, we had three of the presidents, the regional presidents, Charlie Evans, Charlie Plosser, and Narayana Kocherlakota come and talk to us. And this was like maybe within about 4 or 5 days in advance of the FMLC meeting. They did not agree on things, but they agreed to help to educate our undergraduates. Our undergraduates learned about monetary policy from people actively engaged in it, and at a time that was of kind of key importance in kind of restructuring monetary policy. So this was an incredible event for the undergraduates. There was an undergraduate moderator who hosted it, and it was rather interesting. For me, it was interesting too. Trying to get 3 regional Fed presidents to agree on what the rules of the game were for a debate, discussion, and the like was challenging. There were lots of threats not to show up, and various different things happened. But they eventually all came. They were all friendly with each other, and things actually went along quite smoothly. But anyway, it was so part of our aim is to really make this research institute reach out to students and to bring students into why economic research is important along a variety of dimensions. So what I want to talk about in a few minutes, so before I turn this over to our distinguished panel, is uncertainty. Because I think it's going to be kind of pervades a lot of economics, and I think it also is going to be relevant in our panel discussion as well. So here's an interesting picture. It's actually 2 pictures spliced together, as you might ask. And so why would anyone splice these together? So the one person, Jacob Bernoulli, on your left. 300 years ago, motivated by trying to analyze social data, came up with discussions of how quickly can we learn from social data. So if you look where probability theory stood prior to Jacob Bernoulli, it was all about games of chance, situations where you really actually knew probabilities, and then you kind of did a whole bunch of calculations. Jacob Bernoulli's interest is how do we analyze data using probability models, and how quickly can we learn about things. His analysis was much richer than what became known as the law of large numbers, but that was an implication of what he was doing. So if we think about this as a challenge for, my background comes from a field called econometrics. It's about use of statistical methods to analyze economic models. So in some senses, kind of Bernoulli stuff was kind of launching, trying to think about how to use social data in systematic ways and how we might learn about things. But in economic model builders, we face other stuff. We face other forms of uncertainty. This is why the picture on the right is there by Pissarro. It's actually there for 2 reasons. It's also on a cover of a book that Sarge and I recently published, but that's a sideshow. There's people interacting here in a marketplace. They face uncertainty. So there's actually 2 different perspectives of uncertainty that economists have to confront. There's econometricians outside the model trying to figure out what's a good model, but inside our model, there's people trying to figure stuff out too. And there's interplay between these 2, and this became fascinating challenges for economic model building, but it also opens the door to some interesting discussions of, I believe, economic policy, which I will say more about in a few minutes. So let me turn first to this kind of inside the model notion. So I like to think about uncertainty in a few different, as having different components. First is these kind of games of chance. If I have a model, and a fully specified correct model, it tells me probabilities of everything I want to know. And I just look at that model, and I got the I got the answers to this kind of uncertainty quantification. The problem is I don't really know what models I have, and so I may have multiple models. So now the question: if I have multiple models, which ones do I take most seriously? Well, there's issues there about how I might weight models, how I might combine them, and the like. That's another source of uncertainty, not knowing which is the correct model. Now let me take it one step further. Models are always wrong in some sense. I mean, they're abstractions or simplifications. In economics, they're sometimes wrong in some serious ways. We use models as simplifications, as abstractions, but we kind of know it's along some dimensions they're wrong. That's a third source of uncertainty. How do you use sensible models which you know to be wrong, and how do you accommodate the uncertainties attached to them? And so there's been lots of fascinating developments in decision theory related to economics to try to figure out how to generalize our notions of how we write down models that cope with uncertainty, much more broadly conceived than this notion of write down a model and here are all the probabilities, the calculations underlying games of chance. So this is relevant not only for economists as they use models, but also for people inside our models. You know, I struggle figuring out, as an econometrician, trying to figure out what's going on. No doubt, investors inside our models also struggle to know what's going on, and we have to somehow try to capture that. So we imagine consumers, enterprises, policymakers all have to cope with different types of uncertainty, and we have to put that inside our models. And they have potentially interesting, intriguing implications when we do that. There's going to be market responses to and there's going to be consequences for how resources get allocated across the economy and the like. One outcome of this, there's a whole variety of them, one outcome of this is that you get new sources of fluctuations in so-called uncertainty prices. We often go and we hear reports about, wow, the market's really risk-averse today. Well, what exactly does that mean? What is it that drives around kind of how we trade off risk and return in asset markets? And do we really want to think about it as risk in the sense of knowing probabilities of everything, or do we really want to think about it as uncertainty more broadly conceived? And I would argue that this more broadly conceived notion really gives you a richer model and a richer way to view financial markets. But the even more interesting question for tonight's discussion has to do with policy. So let me do a little bit of appeal to authority here just to put some issues on the table. One is Hayek. If you go to Hayek's Nobel address, you get this. This is kind of a Hayek was not always the simplest writer. This is kind of a little bit of a simplification of a statement that he has in his Nobel address. If you read this address, you'll see a Hayek that's somewhat skeptical about the role of about economics trying to imitate other scientific disciplines, and also some skepticism about the role of even using formal economic models for quantitative analysis. A skepticism that I don't fully embrace. But anyway, it's very clear that he takes seriously this notion of limits to our knowledge, and is very concerned that when the public expects economists to know things when they really know them imperfectly, that could be problematic. So while I don't fully embrace Hayek's notion, skepticism of quantitative models in general, my view is we need to figure out how to use those models in sensible ways. There is some interesting warning signs coming from Hayek's discussions here. Also intriguing here, and something that had a big impact on monetary policy in the past is Milton Friedman's statement. Here's a quote from him that I kind of like, where he's quoting somebody else. As Jacques Billings wrote many years ago, the trouble with most folks isn't so much that their ignorance as knowing so many things that ain't so. Pertinent as this remark is to economics in general, is especially so in monetary economics. Now, Friedman was writing in a time where monetary economics is very different than what we'll be talking today. The question is, should we be approaching it with a similar type of skepticism? So this comes to this notion of these kind of policymakers outside the model and how do we use models. If you look at Friedman's arguments, he advocated simple rules because of what was referred to as long and variable lags at the time in the monetary transmission mechanism. So how did the monetary transmission mechanism connect monetary policy movements into real economic activity and for that matter into prices? So currently, we're facing things like forward guidance. We're facing new variants on different forms of monetary policy, and it's interesting to know what role uncertainty plays in these discussions. And this is something which I certainly hope we can talk more about as tonight's discussion unfolds. So let me go back to this Fed policy debate, which we held at the Institute for the undergraduates. At that point in time, there was a shift in policy from this notion of forward guidance. So what was forward guidance? Interest rate policies have been sitting, near zero. They can't go below zero, and so the question is, when does the Fed commit to go to moving interest rates away from zero in the future? Previously to 2012, it was based on, at some future date we plan on doing X. Then comes this change. It's really not the date that we can really tell you. It's more like the state of the economy. So like when unemployment changes to some level in the future, then maybe we'll do something. And so the shift in the policy was to shift towards that. The Fed has this dual mandate. They're supposed to care about price stability, but also unemployment or employment issues. And so this, in December of 2012, they decided to shift forward guidance to things based on these indicators. Now, kind of watch that evolve further. So we first started talking about unemployment as a relevant kind of target. Then, labor markets are more complicated than that. The problem with unemployment numbers, and that this is kind of well recognized, is that they mask much more complicated what's going on in the job market. Unemployment can come down because people leave the labor force, and not because employment itself is rising. Unemployment can come down, but hours of work can be shifting and the like. And so unemployment alone became a flawed indicator. And so then we started just having discussions about looking at more general labor market conditions. And then we run into this question, what does forward guidance really mean as the messages get more and more complicated? So yes, there's complicated problems. The question is at some point in time, if this forward guidance is to have real content, then how does the Fed communicate it? Is this something that's simple and transparent, or something else? Let me also just comment briefly on this policy making from the standpoint of financial oversight and regulation. As many of you may have seen a Wall Street Journal op-ed yesterday that made reference to systemic risk. Systemic risk is, as that article made clear, is not something that economists really have a really clean, formal characterization of, and it's a rather vague concept. Some people, in the past, have referred to this like Potter Stewart's discussion of pornography. You know it when you see it, but it's hard to really get a fully rigorous definition to it. And if it becomes a policy mandate, then there becomes some non-trivial issues associated with that could be actually harmful. So consistent with, so in accordance with the article, financial entities like BlackRock and Fidelity may well be designated as systemically important. Once that designation, it's not clear that this is of great gains to the companies themselves, but kind of once that happens, you run into this concern about things being too big to fail. And so now we're putting more and more of entities under this notion that, we're not going to let them fail potentially once we designate them as systemically important. So the companies themselves have to undergo more detailed financial oversight, and at the same time, the taxpayers have to run the risk of providing insurance in the future. My view is these notions of systemic uncertainty, risk could really be some more general notion of systemic uncertainty, because we really don't fully understand this problem. In fact, in general, my view is that complicated problems do not necessarily require complicated solutions. That's consistent with Friedman's view of monetary policy. I think it always also carries over to our thinking about financial regulation. So I guess the point I really want to be driving home here is, yes, maybe the best way that policymakers influence people is by pretending to that the uncertainty is in the background. But in truth, I think it's better that we face up to that uncertainty, acknowledge it, and then design policies accordingly. This doesn't mean we don't do things. It just means we hopefully do things in more sensible ways. And so finally, if you want some indication of complexity, this comes from Basel III. I stole it. We had a Friedman form from Maury Obstfeld just a couple days ago, and I stole this from him. I'm supposed to be mathematically inclined, but this gives me a headache, so I'm not going to try to explain it to you. But yeah, this formula is under debate between U.S. regulators and European ones as to whether they kind of got all this right and the like. There's kind of similar discussions about the role of risk weights in terms of setting capital requirements and the like. And so issues here about complexity versus how much versus how we understand things, I really think are important topics of conversation. So tonight we're very lucky to have some distinguished panelists. Jeremy Siegel is I first became acquainted with when I wrote one of my first published papers in economics on exchange rates. There's this famous exchange rate paradox called the Siegel paradox that's to this day still exists. And this paper was written in the early 70s, so this is clearly a durable contribution. But I first became acquainted with Jeremy at that point in time. Jeremy's been a long-time friend of first the Milton Friedman Institute and now the Becker Friedman Institute. I know that he's was friends with Milton and Rose Friedman, and he's been a distinguished scholar of both financial markets and the macroeconomy, and we're pleased to have him. Our other panelist, Neal Soss, has this unique perspective coming both from the government and from the private sector, and kind of uniquely blend those things together. Our moderator is Mark Brickell. Now, Mark wanted me to advertise the following. He's the only person among the three of us that has a University of Chicago degree. So so in some sense, he is the only one that should be listened to, I guess, is the thrust of that. Mark is the chief executive of the first electronic derivatives trading platform, now called a swap execution facility. He spent 25 years at J.P. Morgan, where he's managing director. While at Morgan, he served as chairman of the International Swaps and Derivatives Association. He's been long active in public policy formulation regarding derivatives. He's serves on the board of directors of the First Command Financial Services, and he's also been a longtime friend of the Becker Friedman Institute, so I'm happy to turn the stage over to him. Thank you.
Actually asked Lars to advertise was the fact that of the four people up here, only one does not have a PhD. But I'm glad you're here to listen to the other three brilliant panelists, and I'm glad to introduce them in a little more detail. First of all, Lars, early in his life, was a lanky farm boy in Utah. It's not hard to picture. Unlike most of us, he's still lanky. But within a few years, he was earning his doctorate in economics at the University of Minnesota, and according to one person who was there, supervising the dissertations of half the other students in the program. He went on to teach at Carnegie Mellon University before he joined the faculty at the University of Chicago in 1981. And he is now the David Rockefeller Distinguished Service Professor of Economics and Statistics and the research director of the Becker Friedman Institute since 2008. Lars has won international recognition for fundamentally improving the understanding of how economic agents cope with risky, changing environments. And his early work in econometrics delivered a breakthrough, which he has applied to the study of asset pricing puzzles, where real-world financial and economic data are at odds with prevailing academic models. For that work, he was awarded the Nobel Prize in Economics last year. He also has many other honors. He's a member of the American Academy of Arts and Sciences, a fellow of the National Academy of Sciences, and a former president of the Econometric Society. And I know that he values rigorous, independent, nonpartisan scholarship, and believes that his role as a researcher is to distill frontier insights in ways that are accessible and relevant, and use his scholarship to provide a unique perspective. Jeremy Siegel is the Russell Palmer Professor of Finance at the Wharton School at the University of Pennsylvania. He is known colloquially as the Wizard of Wharton, and his research interests include demographics, financial markets, long-run asset returns, and macroeconomics. You've seen him comment extensively on the economy and on financial markets on CNN, on CNBC. You've heard him on NPR. He's a regular columnist for Kiplinger's and contributes articles to the Wall Street Journal, Barron's, and the Financial Times. He's also the author of The Future for Investors and Stocks for the Long Run. He's received many awards for excellence in research and in teaching. And with a BA from Columbia and a PhD from MIT, he still has a good Chicago connection. He graduated from Highland Park High School in Chicago. Jeremy taught for 4 years at the Graduate School of Business at the University of Chicago before he joined the Wharton faculty in 1976. I know that he did this partly because I was his student. Fortunately, this left him intellectually unscathed, and he has completely and mercifully forgotten the event. Neal Soss, the third panelist, is currently the Chief Economist, Investment Banking, here at Credit Suisse, and this is his 30th year at the bank. Prior to joining Credit Suisse in 1984, Neal was with the Federal Reserve Bank of New York, where, as a vice president, his responsibilities included bank supervision and foreign relations. He took a 2-year leave from the New York Fed to help guide the chairman of the Federal Reserve Board of Governors, Paul Volcker, and went on to hold various positions in New York State government, including 3 years in the New York State Banking Department as both deputy and first deputy superintendent of banks. Neal graduated summa cum laude from Williams College in economics and Spanish, and has a PhD in economics from Princeton University. Now, the way we have structured our session this afternoon, we're trying to flow from some specific and practical questions towards the more abstract. We probably won't get through all of it, but we'll spend 45 minutes to an hour and then open the floor up to questions from you. We'll start with the economy and the markets and try to look ahead a little bit as to what we can expect. Then we'll talk about the links between monetary policy and the economy. Third, we'll see if we can draw some lessons from the 2008 housing finance crisis. And finally, we'll talk about the links between financial markets, where nearly all of you, I'm sure, have made your careers, and the real economy. That's how we've planned it. When you have freewheeling intellects like these gentlemen, the moderator throws his harpoon into the first subject, and then we're all off on a Nantucket sleigh ride. So hang on. Let's start, Jeremy, with the first question. Tell us a little bit about what you see for the economy. The recovery has been weak. It's relatively long-lasting already. What do you see looking ahead?
Wow, I'm normally an optimist, but the economic data has really been so very, very poor. As many of you know, just a little more than a week ago, we got the GDP report for first quarter at plus 0.1. Well, the data we've gotten since has been so much worse that now the estimate is closer to minus 1% for the first quarter. Now, in a way, that's puzzling because the labor market data, we hired net 400,000 people in the first 3 months of this year. And what in the heck are they doing? Minus 1% GDP, and we hire 400,000 people. Well, we got the data today. The productivity was sharply negative, minus 1.7 or something like that. Remember, the long-term average is 2.25. Now, yes, some of it could be the weather, and people were hired and counted as working, but they couldn't get to the factories all the time, and certainly that was there. But the productivity record has been very disturbing recently. I'm actually, I have been a productivity optimist in the sense that I believe that productivity gains really come from collaboration on problems, and I think the internet and the internationalization, globalization of research is a very powerful and positive force long run. But we certainly have not seen it over the last 3 years, and that's disappointing. Now we also have the CBO coming out saying that the number of hours worked in the next 10 years are going to be only up at 0.5% a year, the slowest in history, at least, or this century. Part of it is the aging of the baby boomers and retirement, but part of it is also, as they explicitly say, the Obamacare and people not working for firms because they don't have to work to get the health care paid for by the government. 0.5%. Now you can add some productivity level to that, 1.5 maybe, in the overall for the economy. That's 2% for the private sector. You're going to get GDP growth of 2 versus 3.5 in the post-war period. And we're going to talk later on about what that means for interest rates and discount rates. I think it's very significant for asset pricing going forward. What should I say? I mean, the spring data is coming out a little bit better now. Most of the estimates I see are 3.5 to 4% for this quarter, and hopefully 3% for the year. But now we need over 4% in each of the quarters given our first quarter, to get there. So it's very disturbing. I'm still a long run optimist on certain of these trends, but we see the drags are really there.
Neal, can you make the horizon look any brighter by talking about household debt?
Well, the big increase in household debt in recent years, such as it's been, is all in student loans. And of course, most of you know that the student loans aren't performing already. And the best news about that is the government made them. We don't own them individually. We don't own them in financial markets. We only own them in our capacity as citizens and taxpayers in the future. So that's easy to charge off relative to the houses that we financed privately a little while ago. But I think the deeper point, and I think it's very implicit in what Professor Siegel was just saying, is that whatever the empirical regularities of the past, from time to time, the parameterization of the economy changes. We used to get 3.25% GDP on trend, and that wasn't just when the economy was growing. That was the average, including the periods when it was in recession. And of course, in a world like that, you can promise people Medicare and Social Security and so forth and so on, because the economy is going to double every 20 years. Now it's growing 2%. It doesn't double every 20 years, it doubles every 35 years. It's good that it doubles at all. The potential GDP is lower because of the change in fertility, which is a generation old now. It means that you're not getting the entry classes of workers that you used to get. And the claims on the GDP, at least for the next few decades, are higher than they ever were before because of the baby boomers retiring. And the extension of life at old age is very expensive. For those of you who didn't see 60 Minutes this past Sunday, go to their website and get the story. It's both heartwarming because of the people caring for these old folks, and heartbreaking when you see what happens at the extension of life at old age when it extends far enough. And we got a lot of that coming in not so much this decade, but the 20s and 30s of this century. So you got less potential GDP and more claims on it. And that changes, in my view, at least, the way the economy functions, with, I think, profound implications for financial life, which is, in a sense, the congealing of these various issues. And we'll get to that, I'm sure, later on in the talk. I would also point out very quickly, this is not unique to the U.S. In fact, we're in better shape than most. Korea, Japan, China, and so forth are collapsing demographically because of the low fertility. And much of continental Europe is in a similar circumstance. And except for sub-Saharan Africa, there's hardly any big block of the world that is young and staying young. So it's really quite a remarkable thing, probably unprecedented in our history as a species. Talk about uncertainty, Professor Hansen. Things one's never seen before must be more uncertain than things we've had some experience with.
Yeah, so let me just make the following. So not all recessions are caused by financial crises. And indeed, if you look at the kind of conventional wisdom in the U.S., I think in other advanced economies, is we kind of got these financial crises figured out, and they're not going to really infect us very much, and they'll have more minor consequences. They're more an issue for developing countries. Of course, that wisdom has now been challenged and it's been changed. When people look kind of across countries and kind of look, instead of just looking at the U.S., and kind of comparing various different recessions across the U.S., but look across various different countries and various different episodes, then there's at least some evidence that recessions or downturns triggered by financial crises tend to have slower recoveries than other ones. I think it's an interesting question why this is the case, and we certainly seem to be experiencing this in our economy. There's a tricky question for empirical researchers in economics. That is, do we want to think about the U.S. economy as being somehow unique and evidence going across economies is not really pertinent to us, or do we really want to draw heavily on those episodes? And that's an open question in my own mind, but there certainly is evidence that if you look kind of across a whole bunch of different financial episodes, that recoveries are more sluggish coming out of financial crises.
Neal, you alluded to the global nature of these problems. You talked about the demographic problems as well. And Lars, the fiscal challenges that you're talking about relate to the demographic challenge. Is it possible for countries, even our own, to grow their way out of debt with this kind of a future scenario?
This is to me?
Yeah.
Yes. So there's lots of components to this question. So let me, if you look at recent monetary policy statements, there's kind of this feeling that monetary policy is a bit run out of gas, and they're kind of appealing to more help from the fiscal side and hoping for this turnaround. And people advocating kind of short-term fiscal stimulus, kind of the argument is that, well, let's kind of plug it in there now, and then once growth gets back on track, we can kind of take care of it in the future. I'm reminded of an interesting quote from Milton Friedman again, saying that there's nothing so permanent as a temporary government program. That's difficult to really commit these fiscal stimulus programs to just be temporary and then to kind of fix things down the road. I do think myself that fiscal stimulus in times of recessions should be considered, but for the following reasons, or under the following scenarios. I think that there could well be government infrastructure programs that are well thought out, well conceived, kind of shovel ready in advance of the recession, under which we decide now is a good time to make those investments. I mean, maybe the labor market's soft, maybe things are cheap, and kind of now is a good time to do it. That's not the approach we took in our recent fiscal stimulus, which I don't think has been terribly effective. And I do think this idea that we can kind of just stimulate now and we'll correct things later is a bit dangerous. In terms of demographic shifts and the like, I mean, personally, I would like to see us start facing some of our long-term fiscal challenges. I don't know why we're not talking more seriously now about delaying some of the benefits in terms of Medicare, in terms of Social Security and the like. Let's start phasing in those, delaying. The population's living longer and longer, so let's kind of roll back those benefits even further and further, and let's commit to do it now in a very gradual way, so people can kind of go ahead with their planning. I do think that long-term uncertainty connected to how we're going to confront fiscal challenges is a drag on the economy, and I'm certainly concerned about that contribution.
Please.
Yeah, I think when you look long, short run, CBO came out with a debt to GDP. It looks fairly good. Next 5 years, 6 years, it's the long run. And actually, that long run is almost all Medicare and the health. Social Security is slightly out of balance, but it's not a big deal. it's Medicare. And I mean, that's the big long-term challenge. Now, I've done some work that suggests if we start indexing when you get these benefits to life expectancy, that might be workable under some reasonable scenarios. We're living longer and longer and longer, and it's still 65. You get Medicare. More and more people are taking Social Security at 62 than when we first started. In fact, it wasn't even allowed for the first 20 years. That came in the 50s or early 60s. I forget when it was. I mean, so as we're living longer and longer, we made it actually that you retire earlier and earlier. And then, of course, that's just unsustainable. Especially with the demographics and the fertility rates. So something has to be done, particularly on the Medicare side and going forward. And, we could debate what might happen there. But that's to me the biggest challenge.
Yeah, I think we're focusing just a tad too much on sort of which balance sheet we put these problems on. One of the interesting little features of the Republican plan about Medicare last year was they were going to postpone it to age 67. Well, it turns out there are 19 million people in the United States on payrolls who have been promised health care by their employer, and the employer happens to be the state and local sector. And if you move the health care system back to not having Medicare until age 67, then between the ages of 65 and 67, which is the way state and local contracts tend to read, all you've done is to move 19 million people off one balance sheet onto another. And that doesn't change anything. Consolidating these balance sheets matters. It's the GDP that's got to pay for it. And with respect to thinking that Social Security is okay, I think that too is a problem, a little bit of being a bit too narrow with which balance sheet we care about. I was from the outset a very big critic of the 401k. It strikes me as something that uninsures an insurable risk, and the balances are pathetic, to put it bluntly. And that's got to be, once upon a time, we thought of retirement as sort of the multi-legged stool. You got some Social Security, but you had some pension and you had some private savings. Well, pension's gone at the margin and was replaced by 401ks, and the balances really are pathetic. And I don't know what private savings there are given the income distribution for half of our fellow citizens. And that's the key phrase, they're our fellow citizens. They're going to be on the public payroll because otherwise they're going to come to live with us. The consolidated balance sheet means when all is said and done, it's the GDP of 2025 that's got to pay for those people. And getting that to be a bigger GDP ought to be the focus of our attention rather than figuring out whose balance sheet is going to bear that burden, at least in my view.
Jeremy, you've thought a lot about the balances that people have accrued in order to finance retirement. Do you have the same level of concern that Neal does?
No, I mean, we could talk about how much. I mean, obviously, what had happened, I guess what you still enjoy the defined benefit rather than the defined contribution
Well, I
plan.
think I may be the last at Credit Suisse because we closed that to new entrants.
Well, the thing was, you see, the defined benefit plans were good when hospitals were $25 a day. I mean, but they totally became unsustainable, and that's the reason. I mean, it's all connected to the explosion of the medical costs that made firms could not afford. I mean, that was the bankruptcy of General Motors, right? I mean, and the bankruptcy of the steel industry here. It's all of it was on the medical promises. So became unsustainable. I mean, I still believe that private saving is the way that we should encourage to fund our the elderly in our retirement, I would try to make it more attractive rather than less attractive. I mean, doing something like I was down in Chile recently, their retirement plan where they have a mandate. I mean, that's not a rich country, but South American is doing fairly well. Yeah. A big 10% mandatory plan. They have a very well thought out pension plan going forward. And again, that's not a country anywhere near as rich as we are.
Yeah, but if we imposed a 10% of paycheck saving rate at this stage in the business cycle, wouldn't we come back to the, how are we going to get growth?
Yeah, I mean, obviously, these things have to be staged in, obviously over a period of time.
I hear some policy uncertainty, Lars. Do you want to say more about the economy, or are you ready to shift to monetary policy?
I thought monetary policy had to do with the economy.
Well, you'll tell us how much it does. And there may be a little ray of sunlight here, because with all this low growth, maybe we'll have a positive impact, a favorable impact on interest rates. Jeremy, you want to talk about that?
And just those final words, I did mention that and I still hold on to the fact that productivity is caused by collaboration, research, invention. I mean, the internet it goes with the printing press, the invention of paper. I mean, we could go back to the 2 or 3 huge inventions in civilization that have brought forth a burst of productivity, and I still hold on to the next 10, 15 years perhaps showing that. And I mean, we know all about the Solo's statement about we see productivity everywhere, except
in the data.
In the data, and when the computers came out, and when does it actually happen? There's been research articles about electricity when it was first introduced. There was again a lag before we actually got into data. So I'm not a pessimist when you really go long term out. But now monetary policy. What was your question, Mark?
Question about interest rates, Jeremy.
Oh, yeah.
What's the impact of these low rates?
All right. My thoughts on interest rates have gone through somewhat of a evolution over the last year or two. I mean, I thought that we were going to bounce back, much faster. I thought that interest rates were going to, go much higher than they have gone. And now with the slow growth in the economy, the increased risk aversion, the aging of the population, the de-risking of pension funds by the billions of dollars of pensions are just going into bonds and out of stocks because of the regulations, all sorts of reasons. I'm now not sure that we're going to get the long-term rate with the 10-year really much above 3.5, maybe at outside 4, which is much lower than it had been historically. And by the way, the Fed funds rate long run, I think the forecasts of the FOMC are totally wrong there. They have 4.25. In fact, it's been brought up to them. There's a disconnect. We can talk about that. I don't think Fed funds are going to go much above 2 and 2.5, maybe. And this is pretty long. This is a pretty long run. So it still doesn't make it attractive to own bonds at all, because I still think they'll be higher than now, which is the 2-year at 2.5 or 2.58, I guess. But it means that we're just not going to get that real return. Certainly from the fixed income sector that we used to get.
And what about the effect on stock prices?
Well, then that's very interesting, because I've been saying, and I still believe, that these lower real rates should capitalize equities at a higher level, despite the lower growth. I mean, it depends on how you build in the growth, and it depends on what kind of growth model you actually use in terms of that. But it seems to me that if real rates are going down to 2%, and you think of an equity premium of 3, let's say which is historical on stocks and bonds, and we could talk about maybe it's being a little bit more with risk aversion and the elder economy, but let's assume it's 3. I mean, we economists even have a hard time explaining why it's that much. But say it's 3, you get a 5. A 5 is a 20 PE ratio on stocks, looking real. And that's, we're only at, 16, 17 now. So in the transition, I still think stocks haven't quite caught up. If they go higher, their forward-looking returns will be lower than the historical record, but in the transition, you're going to get perhaps still some good years of returns on equities going forward.
So it's an ill wind that blows no good.
But temporarily, if we're going to be living in a lower return world, which lower growth on almost all economic models leads to, then really the capitalization rates, which are just the inverse of that, have to be higher than historically.
So there's a big impact on capitalization rates. Lars, how much impact do you think there is on the real economy? Here's the Fed with a monetary policy. By statute, they have a dual mandate. They've got to achieve price stability and full employment. Is it possible for them to do it? What's their impact on labor markets, short term, long term?
Yes, that's a very good question. So the Fed basically has 2 policies in place now, quantitative easing and forward guidance. The quantitative easing is where they're going and investing in a variety of different type of asset markets. The forward guidance, as I talked about before, is this commitment that they're going to move short-term interest rates depending upon some future state of the economy. It's interesting to me that a lot of the discussion has been about how these tools affect asset markets, and very little of the discussion is about how they affect labor markets. And I think a lot of that has to do with the fact of the empirical evidence we have on their impact on labor markets is just very, very weak. I think even if you look at the strongest proponents of quantitative easing and forward guidance, they're going to be hard pressed to come up with very strong evidence of their positive influence on labor markets. My own view is I really don't. I think there's a very limited amount the Fed can do to really help labor markets right now. We need to be thinking about how to nurture new enterprises, how to nurture and to how to foster economic growth through new productive activities. And I think there's a limited amount that the Fed can do in isolation here. So my own concerns is which as far as policy goes are much more towards financial market oversight and to fiscal policies. Of course, they both interact with monetary policy.
So the stimulus hasn't been particularly stimulative. The quantitative easing isn't, in your view, having a very profound effect on labor markets. And I'm curious about how you all think this will end. The quantitative easing program that we have, others like it in other countries, how long can central banks pursue those policies, and what happens when they begin to unwind them?
Well, they can pursue them as long as the police power of the state makes the liability of the central bank money. And that's easy. Take out a dollar bill and you will see it says this bill is legal tender. That means if you present it, they have to accept it. Fed wire is final settlement. I suspect people here in the clearing areas would recognize that proposition.
Except when you buy snacks on the airlines. They don't accept currency.
And it's also kind of remarkable to try to pay for a taxi ride in New York with a $50 or $100 bill. I recognize that. But in law, interestingly, they can't turn you down. They just do in the real world. Yeah. But seriously, as long as the liability of a central bank is through the police power of the state rendered money, central bank doesn't need a positive capital position. It can run an indefinitely large balance sheet, and so forth and so on. I think the how does this all end has a lot to do with simply the passage of time. And we've been thinking, even preceding Milton Friedman, about the idea that monetary policy is more efficient at restraint than at stimulus. X number of basis points stops things more reliably, if you will, than X number of basis points can stimulate them in the other direction. The new lesson in the last few years, I think, is that monetary policy is more efficient at dealing with the fat tail of risk in a systemic moment Lehman, for example. It's more efficient at that than it is at dealing with the long tail of the kind of sluggishness that the economy's been experiencing. Whether that's because it's a post-crisis event or because of the demographic forces, or maybe we just got unlucky and the two came coincidentally, monetary policy is simply less efficient at the long tail than at the fat tail. That's no reason not to use it. It may not be it may not be as efficient in one context as in another, but it may be the only tool you got. And this notion of, well, let's get one policy and set it and the world will be fine for the rest of history is, in my view, a sin of hubris. You deal with the problems you got, and the way in which you deal with them almost assuredly gives you the next set of problems, and that's great for people in financial life, and it's especially great for economists and forecasters.
I would like to continue on some of these thoughts. I first would like to say that so many people, if they don't like the low interest rates or blame it on the Fed, I think there are fundamental forces that have pushed these interest rates down. Mm-hmm. Really, I don't think the real reason that the interest rates are lower is that much to do with the Fed. There's really these low growth, there's the risk aversion in there. I mean, how much can they really control the real rate? It's so amazing to me because I meet people in the financial market all the time. 10, 15 years ago, to a one, they said, oh, yeah, the Fed controls short range like the Fed funds. They have no control over the bond. Right. Remember the bond vigilantes? They'll come and do that. Now, these same people are complaining about how much the Fed controls the long rate. That they're propping it, they're repressing it, like there's not a free market in it. I mean, where's the disconnect that's going on? Really, these low rates are due to fundamental reasons and low inflation and the low real rates that we really should have. Now, also, I'm one of the few fans, actually, of quantitative easing. I think it was a good idea. I think that it was time to limit it as they did, but I think that they basically were trying to answer a tremendous ratchet up of demand in liquidity, short-term safe assets. I mean, one of the things that was so striking on the week that Lehman went under, and I had only read about it in textbooks about the Depression. I remember teaching, and when I was teaching in Chicago, we would talk about the Treasury bill. A successful Treasury bill auction was when the 90-day was 8 basis points. That was big. And we would laugh because the Treasury bill was, 18% at that time. No one thought I never thought. And when Lehman went under, and I saw that Treasury bill auction, that at any price, they wanted bills. And they went, I got this chill down my back. I said, this is like the Depression. This is the panic that came, let me have liquidity. And that's what people want. That's why they still hold money funds at zero. There are trillions of dollars, tens of trillions of dollars that people just hold at zero interest rates. Now, albeit inflation is low, but it's 1.5 to 2, so you're getting a minus 1.5 to 2. And I think what the Fed is saying is I'm going to supply a lot of that to the banks because they want to hold a lot of these reserves. Now, the big question becomes when confidence comes back. I don't say when and if because I do believe it will eventually. Maybe I should say if. But, the question is, what do they do with all that liquidity? And I've actually written some material on that. And I think that what they should do is just increase capital and reserve requirements dramatically. I mean, the banks are holding it voluntarily now. And as they're paying interest on reserves, they can always pay some interest on the reserves. It isn't that much of a burden. So my feeling is we're going to see a big increase in mandatory reserve requirements, capital ratios. You can really do away with Basel completely if you just tell them to hold these. The $3 trillion, hey, you're just not going to hold up, pay some interest on it. You can do away with Basel. You don't need anything else. I mean, there's a lot of ways you can go about to neutralize the so-called tinder that's there now in the banking system.
Other thoughts? That's a pretty rosy prospect.
That is a major concern. That again, there was a during the last FOMC meeting, last week, it was reported that the board actually had a private meeting, and there was some talk about looking ahead at what are they going to do. I mean, tapering is on course to end in October. Janet Yellen let slip 6 months afterwards. Now she says she doesn't really mean it, but we're thinking about next April would be maybe the time they start raising rates. Of course, it's all dependent on what happens on the economy. But then you start thinking about, what are you going to do with all those reserves? Are you going to continue to pay interest on them? At what rate? What margin to the funds rate? I mean, those things, they need to start discussion on those.
Yeah. Now, plumbing matters, but it's still plumbing compared to the fundamental forces.
Yeah, the fundamental forces are, huge that are impacting, and I say that this shock to liquidity, because of how it was 65% decline in the stock market. Remember, that's the biggest decline since the 30s. We've never had. And that's worldwide. Europe had the same. All of a sudden, we saw what happened after the 30s. There was demand for the T-bill rates remained low for 10 years, 15 years until the war, actually. Then they were, pretty much controlled until after the war. But there was such a shock that, okay, I want to stay liquid, that, zero rates, no.
But when events, I very much agree with that analysis, that this was a money supply shock that gave rise to a money demand shock, breaking the buck and so forth and so on. But when you have events that are that infrequent, right, what does an econometrician do to help us out? What do you do with a sample of 2, or maybe 3 if you include Japan in the 90s? How do we make inference from that?
So here's the interesting question: how much do you want to appeal to cross-country evidence? How much do you want to look elsewhere? Do you think how much uniqueness do you think there is in the U.S. economy? I don't have a good answer for that, but more and more people are trying to look elsewhere to other financial crises to get insights out of those as well.
When Japan is always, we always used to say, we're not going to get into Japan because Japan made so many bad mistakes that let deflation go, blah blah blah. But now we're beginning to think that that zero interest rate with the shock on the stock market and the aging of the economy, which is more aged in Japan than I guess any other country, certainly with any significant GDP. We sort of see a replay of that in our economies in Europe and the U.S. also with the aging of the economy and a liquidity shock that occurred, a similar desire for that liquidity.
So I certainly agree that that time of the financial crisis, there was a big need of providing liquidity, and I think the Fed did a lot of very smart things in order to prevent things from getting worse. But I thought the long term. I thought the issue about quantitative easing is this issue about how long do we keep it up and how long do we keep it going and like that, and which is what role is it serving now? So maybe just gradually withdrawal is okay, and maybe it's not very harmful at some level. I just don't view that as a good source for helping unemployment right now, and I just think we have to look elsewhere.
Yeah. Well, this is giving us a nice segue into looking back a few years at the crisis in 2008. We've talked about its effects. What about its causes? That crisis is cited by some journalists, by some politicians, as proof that free markets don't work. More regulation is needed. One Nobel Prize winner wrote last week in the New York Times on the editorial page that few realized how fragile our deregulated financial system had become. And that logic, I think, drives the Dodd-Frank.
That was Gene Fama, right?
It was not Gene Fama. That was a Princeton man. So, for you, Lars, and for others, is that what the housing finance crisis proved? That there wasn't enough government involvement in the financial sector? Or did it prove something else?
I I think all the details and issues about the full understanding of the financial crisis remains to be seen and remains to be determined. It's not so simple because of the role of both Fannie and Freddie in the housing market, which was certainly encouraged by the government. We certainly have. I still fail to understand why we have tax breaks on second mortgages. I'm certainly happy to exploit them, but they just seem to me totally crazy. Maybe about 6 or 7 years ago, my wife bought into a boat on Lake Michigan, and temporarily we were allowed to use, since you could actually, there was a bed on the boat, you could actually, and we could potentially sleep on it. We were allowed to use that as part of our second mortgage, which seems totally nuts to me. So I mean, there's different things which the government did do to kind of prop up, to kind of encourage the housing part. So I don't think we can run this experiment that it's all, that it was all induced by that. But on the other hand, there is a more serious issue that I think of, that is this: if we're going to really be providing some type of implicit guarantees to big financial institutions, then we have to oversee them. So we either have to be prepared to figure out ways to let them fail, or then we're going to be stuck with having some form of financial market oversight. Now, I think we do want to provide deposit insurance for banks and like this. So I do think there has to be some oversight. The question is, where do you draw the line, and kind of at what point how far do you expand this notion of these financial institutions which require oversight? And I think it's dangerous to kind of really push too far in this too big to fail notion. I really think at some point in time we're going to have to let a big financial institution fail going forward in order to correct things. Because right now I think the expectations is that they'll be propped up.
Well, we did. We let Lehman go.
Yes. Since Lehman, now we're stuck into this regime that we're not going to let the future ones go.
That lasted 24 hours. When you go, I've written a bit on the cause of the financial crisis. It was a confluence of a number of events. Critically, I think there was a huge role to the AAA ratings that Standard & Poor's and Moody's gave to these securities, because that enabled these firms to leverage 50 to 1, 70 to 1, enabled them to sell them everywhere and abroad as long as they were stamped with that. And I think there's also a huge failure. I mean, I think the only personage that could really have looked at the balance sheets of Bear and Lehman and some of those, say you are over leveraged in these risky, they are AAA, but would be Greenspan, who then admitted he never looked at the balance sheets because he just didn't think that they would ever put their shareholders at risk, so to speak. And what Lars said also in terms of government encouraging all these subprime mortgages, because that was, all those sort of came together at that one point, and that fueled the housing prices, which went way above equilibrium levels that we had seen before in ratios to income. So, and that, of course, and once those prices went down, then there was a question of, well, are these really insured or not? Or who is really insuring them, and why were they stamped AAA and they never should have been? It's really, that sort of situation. When we talk about too big to fail, there's so many, these firms, look at AIG was saved, within hours after Lehman went under. But saved and only, they lost hundreds of billions of dollars of equity. It's like we bailed out all these people and the CEOs are just as good as they were before. Those shareholders lost hundreds of billions. If we have enough equity cushion there, make it painful enough. It was really painful. It wasn't like, we talk about bailing off as, everyone was made whole again. There were trillions of dollars of losses that were taken, only partially recovered because some of it was liquidity, not really solvency there. But if you just have to have enough equity, and you make it painful enough, they're not going to get in that situation again. None of them would have ever gotten in that situation again. The CEOs and everyone else lost hundreds of billions of dollars and never been recouped. The bondholders, yes, they finally got their money, although I don't know if they were they're so anxious to get their money in such a way anymore. It took a while with a lot of nail biting. So in a way, this idea that, we bailed all these people out, yeah, but, you just need to have enough equity there. By the way, in the world market, you can't break up these big institutions because globally it's the only way they're going to compete. When we go to the emerging world, if J.P. Morgan are never going to be broken up to a quarter of their size, they're just not going to deal with it, and they'll go to the big banks elsewhere. And I don't think that is really the solution. I think the solution is really just enough equity to make it hurt. You got to make enough people hurt, and then they will never get in that position again. Never. Of course, with that proviso that there always could be a better. 75 years between the 30s and the last crisis. Every 75 years, I'll buy that.
Yeah, even with the extension of life at old age. We can afford to wait 75 years for the next one.
We don't need to do that.
You make a very powerful point. There was a time when the investment banks were partnerships, and partnerships would not lever the way
that much.
These companies did. And what made Wall Street migrate from a partnership structure to a public ownership structure was, when all is said and done, the transmutation of fixed income into bonds, into a performance instrument, mark-to-market, levered, and all the rest. Should we have prevented that? Well, it bought us 25 or 30 years of prosperity.
Yeah.
Not so obvious that paying for that at the end, as we have, makes it a bad trade. And let me finish the point.
Yeah.
Banks, once upon a time, were incorporated in such a fashion that there was liability on the founding shareholders in the event that the bank
and the directors
had
had personal liability.
Exactly.
So they understood the problems with financial institutions, and it was in the 50s the banks that were corporate form, but they were never traded.
That's right.
Financial institutions were never even in the S&P until the 1970s.
Actually, if I remember right, they weren't permitted to be listed.
Well, they were all on NASDAQ, and they didn't take NASDAQ at that time, but they were hardly ever traded.
Right.
And these were the banks. We're not even talking about the I-banks like Salomon and Goldman and all that transformed from being, again, partnerships where the risk was really important to public ownership.
Yeah, and the irony is there were financial crises in that regime too, but they were 75 years before, and so we didn't have to live through those ones either.
That's right.
As a bank holding company director, I'm becoming uncomfortable with the line of thinking here, and I'm very well aware that Lars has a point he'd like to make, so please.
It may not be the point you want me to make.
Go ahead. That's fine.
But I do have some point. So first I have to respond to the Lehman comment. My concern about too big to fail was post-Lehman. It was because of the reactions to Lehman and a seemingly commitment going forward. Now, when you measure the costs, we have to take the hard part of the cost of measurement is government policies putting in place incentives for kind of bad behavior going forward, and so that's also costly, and that's the part that's much harder to measure. This whole called moral hazard concerns and like that. So it's a little bit tricky to back out these cost estimates. I'm all in favor of for the banking sector to have equity requirements and to have much greater equity requirements than we have now. I also do think that we need to figure out ways to have counterparts to bankruptcy, even if they involve government takeover, so we're not so fearful, so the whole collective population isn't so fearful of the failures. We have to figure out ways to kind of resolve them much more quickly in ways that that we as a public are not so fearful of this event happening, and so that we can have some conviction that it might happen, and therefore it will help to encourage better behavior going forward. Now that Dodd-Frank makes some progress on this. It makes progress on that. Unfortunately, I'm concerned about the Dodd-Frank. The Treasury Secretary plays roles. There's still a bit of a political football in all this, and so it's a step in the right direction. But I also do agree that I'm very much in favor of equity requirements for the financial institutions which we're choosing to be supporting and nurturing, and I do agree that can also be a good force for better behavior.
What do you think, Neal? There was a poster on bulletin boards when I was on campus in Chicago in the 70s. Said, the logic of intervention is cumulative. And you start with bank deposit insurance, and then you have bank regulation, and then you have Fannie and Freddie, and then you have institutions that are too big to fail, and now you need to substitute government oversight for market discipline because you've taken away the market discipline by making institutions that are too big to fail. And here we are now with Dodd-Frank, which which tries to substitute a much higher level of government oversight for the market discipline that disappears. But it may also add to the too big to fail problem. Neal, you're closer to this than others, and maybe it may be something you want to comment on or something you want to avoid. But what do you think of Dodd-Frank?
Well, in my current job, I'll avoid it, but I would point out that I did spend a considerable time as a bank regulator before I got here. And I think it was not an unreasonable trade-off to say you're going to get deposit insurance, and in return for that, there'll be some control over your behavior. And ironically, it was the deregulation, after all, that gave you market discipline. And I want to repeat the point. We got 25 or 30 good years out of that before that regime failed, too. So maybe the point is that everything we do will, in due course, need to be changed because nothing works forever until the second coming, which it is the season, after all, post-Easter here. Having said that, I want to pose a question which I've said this in a number of academic settings, and they threaten to take back my PhD. But I, having been in practice doing this for a long, long time now, I'm increasingly persuaded that the demand curve for assets is upward sloping, not downward sloping. And that is to say, volumes are higher at rising prices. Auctions bring out buyers, for those of you who are bond market junkies and so forth. And if that's so, then it tells you a little bit about why that instability crops up in asset markets from time to time. And it's, as I say, people threaten to take away my PhD, but I'm willing to hang out on this one.
That's the whole literature on momentum stocks, momentum assets. In the short run, if you ride the wave,
yep.
That can be profitable.
Next time you see Bert Malkiel, will you tell him that?
But in the long run, I mean, when the wave breaks, you got to really watch out. I mean, that's been a feature of financial markets forever, for hundreds of years. I mean, it's something you accept that, in the short run, if you're right there, and ready to pull that trigger, you might get some sort of gain. The value players say, hey, if I think it's going crazy there, I may lose in the short run, but I'll take it. So, I mean, I think that tension has always been with financial markets and does cause some of the short-term volatility in them. I'm not going to get into a debate about whether they should be excessive or not. I mean, Lars was part of a Nobel group that debated that very fact. But I think, listen, the gains of free markets are way and above the fact that you're going to have some of these short-run instabilities. Also, just mentioning, and I think I'm right, Milton Friedman was a supporter of deposit insurance. Yeah, sure. So when a lot of free marketers, are shocked to hear that, right? I mean, but he was, he thought that really solved the problem. In the earlier days before that, he talked about 100% reserves, and the recent movement, even now, about 100% reserves, which is, again, another way of making sure you separate the lending part from the deposit part. But Milton was very clear. He thought that was the reason why he had the stability, but he said we never have a depression again. And actually, he's right.
In some ways,
he's right. We had a severe recession, but he did not have a depression again.
This actually, in a way, goes back to our earlier conversation. If you think of that willingness of Friedman to support what seems so out of character for the rest of his political philosophy, in a sense, the economics beneath that is what's the optimal insurance pool? What's the optimal insurable pool? The answer is not one bank at a time, but the society. And I think that goes back to the whole question of how are we going to deal with the entitlements?
Yeah, it's so interesting in talking about politics, because the current libertarian movement is, on the monetary side, so much more extreme than Friedman ever. Of course, I mean, do away with the Fed and all that. We have competitive money. I guess we all will trade bitcoins, or how wonderful that is. I don't know. I'm called a statist by a number of people because I support the Fed generally. I'm not going to say they do everything right, and I support deposit insurance generally. And nowadays, that's sometimes.
Well, they certainly support a lot of economists over there. We'll give them credit for that. I promised that we would take questions from the audience, and I think it's a good time for us to begin doing that. In the back.
Professor Siegel, you alluded to the fact that it was a good thing that banks were bigger because then they could go and make loans around the world. But you didn't really explain that, and my question is, what would be so bad, for example, if American banks were smaller, and we let the Swiss finance mortgage loans in Chicago?
Well, the emerging world, is growing very, very fast. They need finance. Finance is important. I don't see why U.S. expertise should not contribute to that. And again, if you put enough equity in it, and those loans, maybe preferreds, or you decide right now. Part of Dodd-Frank is really trying to say what is going to go under and what is not going to go under. If you put enough of that in, I'll be satisfied. So if in a crisis, that you might have the government getting the senior people out, I don't think that that's too great a cost to pay for really disappearing from the world scene. U.S. is still considered number one in financial innovation and in financial expertise. We get the world coming here to learn about it, and I think giving that up, if we break up all the banks, now we wouldn't be giving up the IPOs, the equity part, and that's another thing. But I think that would not be that good. What do you think?
Well, I was actually more thinking that your question would go not to financing mortgages, particularly on boats in Chicago, but who's going to finance Procter & Gamble? And Procter & Gamble is a global company. It happens to be listed here, it's headquartered here, and so forth and so on. But its needs for finance, even if you think of it as just the simplest kind of treasury function of agglomerating the various cash flows that are implicit in selling products all over the world and producing in various locations around the world and so forth, it's not obvious to me why you wouldn't want a U.S. bank to have an opportunity to finance Procter & Gamble, why you'd cede that business, so to speak, or perhaps more forcefully stated, force that business onto the banking systems of some other people. And in the spirit of Professor Hansen's earlier observations, think cross-sectionally. What makes you think those banks wouldn't get into the same sorts of issues?
When you and I started out in business, companies like Procter & Gamble were proud of the fact that they had 30 banking entities that they dealt with. And it was for that very reason.
Yeah.
So why is that such a bad model?
Yeah, no, this gets, because if you want to be one of those 30 nowadays, you got to be on a scale. But it gets to another hobby horse of mine, which is another speech. We'll talk over dinner if you stay around, which is that the banking system, in my view, is illustrative of something that I think we see in evolutionary biology, evolutionary theory too, which is that there's a trade-off between the riskiness of each entity and the riskiness of the system. And the way we wound up getting the banks we've got is when we gave up the unit banking and the state limited banking and so forth in the U.S., for example. In those days, the shocks were idiosyncratic, so oil patch shocks might hurt Texas banks, but there were banks in North Carolina that could come to the rescue. And since we didn't want to use public money because they were too big to fail politically, we told the North Carolina banks, well, go ahead, go buy the Texas banks. The net of which is you wound up with banks that are really very, very big and that tend to look more like one another. They're less diversified relative to one another, even though they're more diversified geographically, product area, and so forth. It's a long speech. It's for different.
I think it's also, I hear what you're saying. I think it's also really interesting to reflect on the fact that the only time, or virtually the only time, the U.S. lost money, the government, on loaning was a savings and loan crisis. $180 billion. It is really fascinating because we all know, all of TARP was paid back by the financial institution. The U.S. government made billions of dollars of profit. Now, the average American doesn't seem to understand that. I mean, that they made so much money. It didn't cost a dime. All right? The savings and loan crisis, if you use today's dollars, cost probably about $500 billion of taxpayer money that was never recovered. Did we have these debates about let's go after all the bankers and everything else after that crisis, which really cost the taxpayer money, compared to this, which did not? It's puzzling to me why there is this. I mean, is it a gap of knowledge, of understanding, of information? These were, I'm just throwing this out in terms of political developments and the cost of bailouts and the cost of too big to fail.
Front row.
You talked about the lots of money being in cash right now, money markets, and the interest very low. And I did physics in Chicago, so I thought there was potential energy of all this dam of money being growing, and it's going to have to go, feel to me like it would have to go somewhere. You might go into equities and then feel that you're going to come out of the bubble. I'm not going to talk about this year, but short to medium term. Can you comment on that? And what's going to happen with all that money? How it's going to affect not just the assets, but also the job market?
Well, the important thing is that the increase of money by the quantitative easing has gone into reserves. It has not gone into M1 and M2. One of the other great insights of Milton Friedman, and it played out so beautifully recently, he said, don't just look at the base. The Fed was increasing the base during the 1930s. He said, look at M1 and M2. That was collapsing. That's the most important variable to look at. Well, do it again. The base is exploding. Is M2 exploding? No. I just plotted on a log basis. It's a straight line over the last 10 years. There's no increase in it. He was absolutely right. And he was proved out in this crisis about which monetary variable is important. It's interesting to see that. Now, can that excess reserves pump in the money? That's the thing about eventually you have to immobilize it or pay interest at it and avoid this compare. That's the question.
That's the question,
right.
yes.
Because otherwise, if interest rates go for 4 or 5% and the reserves are paying a quarter, it's all going to go out. Right.
And that goes to the point earlier about can you grow out of the debt? And the answer is pretty much all of our history in the last couple of centuries is that people do indeed grow out of the debt. The question is how fast.
Question with
here.
inflation or real growth.
That too, absolutely.
Can you comment a little bit about the nature of growth in the U.S. economy, especially most recently compared to what 20 years ago? And what does it mean for monetary policy, especially in the world of globalization? Technology is being so disruptive. A typical example is Amazon and Walmart. Walmart employs 2.1 million people. Amazon employs 85,000. So if you look at the world today and how disruptive technology is going to be, you're going to end up with excess labor. In a world which is totally connected, like globalization, monetary policies seem to be less effective, especially seen only in the US-centric way, because emerging markets have created all the work. So if all their reserves, they can deal with the cheapest, more yields even further. So can you comment a little bit about that, whether you see monetary policy ever having action? Or do we need to kind of review the model, maybe the price zero of side of government?
If you tighten, you'll get traction.
Well, you mean traction on stimulus? Well, one of the oldest sayings in monetary policy, is monetary policy is like pushing on a string, pulling on a string. You can't get anywhere. You get very little on the downside. But let us remember something that's really important. It's my feeling that had the Fed not taken the emergency measures that it did following the Lehman collapse, that it is very likely we would have had a repeat of the 30s, which was a 25% drop in real GDP. We had a 5.8% drop in real GDP. It started out as scary, if not scarier. As I told you, what was happening to Treasury bills, what was happening to the stock market. Stock market was tracing exactly the same way. Everything was tracing the same way. The only difference was the Fed didn't provide any liquidity back then. So when we say, a lot of people saying, oh, the Fed hasn't done anything, again, it's the counterfactual, we'll never know. But yet, when you look at those two events, there was a significant difference in the outcome.
Time for one more question. In the back?
My main question is about the real rate of interest, and it has various subparts. Doesn't economic theory tell us that the real rate of interest equals economic growth in the long term? And we have to look at economic growth in a global perspective. That's part A. Part B, I'm puzzled about the demographics question. Isn't the echo baby boomer generation a larger sample than the current baby boomer generation? So a greater number of people are going to come into the workforce. And then finally, there's the interplay of the real rate of interest with what the Fed is doing. For example, recently, there's been some news in the press, and data analysis shows that the Fed, even though it is tapering, it is buying proportionately more longer duration securities to ease the pain of tapering.
Let me start. Well, you're right. Yeah. At the first Lagrangian is the marginal product of capital equals the... Okay. All models have real growth rates significantly affecting, real GDP growth rates significantly affecting real rates, in addition to other variables. Per capita consumption, there's a risk aversion there also if you're dealing with a risk-free rate rather than, in an uncertainty model. So there are other factors. Lars know much better than I on all the factors that are in there in the determining of the rate of interest. Now, you make an interesting point. U.S. GDP is lower, but what about the world? Well, believe it or not, in the last couple of years, the world has been lower. First of all, Japan and Europe, we know, slower than the U.S., Europe particularly. So the developed world, which is still 55% of GDP, has been much slower, and we've seen a big slowdown, at least over the last year, in China and India, which were the biggest there. So really, we do see real growth on a global scale actually going down, and that would be consistent with those real rates going down around the world.
And what you cite is an equilibrium condition. And with all due respect to our physics undergraduate over here, I don't expect to observe equilibrium very often in the real world. I expect to observe...
But there's an interesting question about do we really have an aging of the economy when we have more of the echo boomers? But the wealth is still, if you take a look at who holds the wealth around the world, it is getting into older and older hands as time. Now, hopefully, maybe the emerging markets, if they become really rich and the younger people, come up, that will move it in the opposite direction. But the data, if you weight the age of the population by the assets they have, it is getting older and older.
Also, the generation between the baby boomers and the echo is really very, very small. And that's what's driving, for example, the statistics that Professor Siegel cited earlier about potential growth being linked to growth in the potential size of the labor force. So if you do long-term demographic projections of the kind that are implicit in your question, you do eventually stabilize the old age dependency ratio in this economy and some others. You never stabilize it in Japan or Korea or China unless they start getting some babies. That's a different issue. Their fertility is still below replacement in all those places. That's a population which predictably will go to zero, except that, of course, we know it won't come to pass. It's one of those things where the risk is easy, so to speak, and the uncertainty is tilted in a very specific direction. So the answer to your question is we will, in due course, in the U.S., for example, thinking of that as a closed system, stabilize the old age dependency ratio, but the experience of the 20s and into the 30s of this century looks pretty difficult to plow through, so to speak. Also, people talk loosely about how people living longer, they should work longer, and so forth. Part of the problem with that is that our labor markets tend to be organized in a hierarchical fashion, and if you can't get the people at the top to get the hell out of the way, it's difficult for the younger folks to move up unless you're in a growing kind of environment. And so it all comes back to getting that growth to happen. And in that spirit, I don't know as quantitative easing works or doesn't work, but I'm glad that somebody's trying something.
Well, I want to thank you, audience, for being such a great audience. You've stayed awake. You've asked excellent questions, and your low rate of attrition as we passed 6:30 is a real compliment to our speakers. We'd like to buy you a drink. Thank you, Credit Suisse. But first, let's give a round of applause to our speakers.